Now's the time to invest in listed property, or is it? Craig Smith, Property Analyst and Portfolio Manager in Listed Property Franchise at Stanlib, joins us for more. Craig, let's just give us a big picture idea of the scale of this sector, of the listed property sector. It certainly has consolidated in the last couple of years. So how many billions are we talking about? The big players, the landscape?
So the listed sector is roughly about 220 billion at the moment. It's grown significantly over the last 10 years, and that's been on the back of a lot of new listings that have come to market over that period. And you have seen consolidation in the recent past, and we certainly see that as a continuing trend in the short to medium term.
Are you watching the interest rates with a close eye? Do they have a significant impact on the asset class broadly?
So it does. So property is highly correlated to bonds. So you've obviously seen since the end of May last year, 2013, with the Fed's comments that they would start to look to taper the bond buying program. You saw that had an impact on listed property over the ensuing months. So certainly the interest rate outlook does have an impact on listed property, and that's why we watch very closely the 10-year bond yields, which it tends to track quite closely.
Looking at access to this sector, we know some of the big institutions are in that field. Well, I found in our discussions in the studio, often we don't talk about listed property, and many of our market watchers don't particularly want to talk about it. It's almost like it's a special class with its own language and its own, as you say, the bond linkage, for example. So what access is there for ordinary investors, retail investors?
So obviously the easiest way for the man on the street to invest in listed property is through a unit trust. So you find that most of the insurance and asset management companies offer this platform where they have dedicated listed property funds, and with the minimum requirement, monthly contribution or lump sum. So that would be the easiest entry point for the man on the street to invest in listed property. And one would advocate that as opposed to investing directly in individual stocks, just because one gets the benefit of diversification and active asset management.
I suppose the follow-up question is now a good time to get into those unit trusts?
So the sector in the short term is obviously going to take its lead from the bond markets, from the capital markets. We're certainly still seeing that the property fundamentals are still healthy, strong. You're finding most companies are achieving their distribution guidance, and in fact outpacing that distribution growth. So you've had the likes of Resilient, Growth Point, some of the big counters, Hyprop, which have actually exceeded the market's expectations in terms of their distribution growth. So they're still managing to grow the income, and that's why we always emphasize listed property as an investment, over the long term in the income play that property provides. So you have a yield, and that yield typically grows by inflation or outpaces inflation.
How important is offshore exposure as you make that decision about whether or not to buy a stock or that's in the listed property space?
So what you found over the last couple of years, you've certainly seen a number of companies starting to invest outside of South Africa, particularly in Europe, Eastern Europe and Australia. Growth Point's got exposure to Growth Point Australia. You've got the likes of Resilient that has got exposure to NEPI. NEPI is a company that focuses on Eastern Europe, particularly Romania, and they're growing their distributions at a fantastic pace. And all of the lease income is in euros, so you do have that benefit of a rand hedge element in this period where the rand is certainly quite volatile.
How does our sector rate as a destination for investors compared to some of the other big property sectors elsewhere? To my mind, it seems we're quite sophisticated and good access for investors.
Yes, I think that's quite true. Certainly from emerging markets, South Africa ranks quite favorably. The market's fairly transparent, and you've recently had the migration to SA REITs, REIT legislation, which is pretty much a global standard, and it ties in what those standards would be across the globe, and that makes it easier for investors to understand the market, and certainly transparency is a big thing for them.
Just yesterday there was news coming out that German real estate company Sirius is planning to list on the JSE. Again, are we seeing a lot of European players, and maybe I should say broadly international players, looking at the JSE as an attractive bourse to be listed on?
So certainly, but what you will find is typically that those companies have got a fairly large South African shareholder base already. So South Africans understand that company quite well, and Germany is certainly a market that, from a property point of view, that's performing quite healthily, and Sirius in particular is attractive in terms of its share price relative to its net asset value. So.
Looking at the consolidation that you talked about in the sector, I mean, there's some very big beasts there now. Is more consolidation due? Are there competition issues coming down the line?
I think, up to date, the competition issues, obviously the process is duly followed, and there haven't been any instances where, mergers or corporate activity has been declined by the Competition Commission. And I think that's by virtue of the fact that there is still a lot of stock that's held outside of the listed sector. And certainly when you do find these mergers, it's not what the Competition Commission looks at more closely is the concentration in specific nodes. So you generally find that even the bigger counters as a percentage of certain nodes is not of a scale or magnitude that would be anti-competitive. But just talking to that point, I think we certainly do see further consolidation within the sector, especially as bond yields and the cost of capital starts to increase. You're finding that certainly direct property opportunities are going to become fewer and fewer. It's going to be more difficult for those transactions to happen, and you will find that lots of companies will use their paper. They're issuing shares as a mechanism to consolidate, particularly in the smaller to mid-cap companies.
And how strong is the Africa expansion story when we put it within listed property conversations?
So it's still small relative to certainly the investments that these companies have in South Africa, but it is growing. And you've seen with the likes of Hyprop, they've given an indication that they're looking to increase their exposure into Africa. So they're committing additional capital. I think it's 3 billion that they're looking to expand into Africa over the next couple of years. And certainly you are finding that more and more companies, the likes of Resilient, Atterbury, Attack, are going into Africa as they find those markets quite attractive.
Which markets are perhaps most attractive on the African continent? Nigeria comes up a lot, but there are at least 54 other states to be looking at.
So I think the big ones that are focused on at the moment are typically Nigeria and Ghana, and that's where most of the certainly developers and the listed property players are focusing on. I think that's as a function of just the sheer scope of those markets and the undersupply of attractive property assets.